For the past few years, Adani Group stocks have caught the fancy of the markets. Shockingly, of the total gain in market cap of all listed Indian stocks in 2022, 79% was registered only in Adani's listed companies. As stock prices of the group's 7 listed companies soared from one high to the next over time, even skeptics converted into believers, loading up their portfolios with the group's shares. In recent weeks, the colossal loss in valuations have shocked investors as they watched multi-year gains evaporate within a few trading sessions. But most seasoned investors were unaffected as they had little or no exposure to the group. After all, this was not their first dance. Over the decades, the markets have seen numerous businessmen and their groups catapult into the limelight, only to fade away or fall on the sidelines equally soon. And while it would be too soon to write an obituary for the Adani Group, one thing is for certain. Businesses come and go, trends change with time, and market darlings often become laggards. But there will always be some companies that just seem to go on and on and on. In the age of constant buyouts, mergers, and bankruptcies, it would seem like there is no such thing as a brand anymore. But of course, there is. There are companies that have survived crises, reinvented themselves, worked harder than ever before, and thrived. In this ever-changing world where preferences change faster than ever before, long-term investors value something more constant. Because long-term investors choose to stick with businesses that make sense, not this year or the next, but over the long run, rather than trying to chase performance for a couple of quarters. It's natural for companies to wax and wane in size, of course. One-time stalwarts fall out of favor, or their businesses succumb to changing consumer and business trends. If being in the BSE 30 is a sign a company has made it to blue chip status, then being kicked out of it may be a sign that the world has moved on. But by and large, what truly gets the world's best investors excited are shares of companies that are slightly more expensive but offer exposure to exceptional businesses. These are companies with high quality operations, strong growth prospects, and solid share price momentum. For this article, we looked at data from 50 bluest of blue chip stocks and crunched some numbers to identify and understand what makes these stocks eternally popular. Based on this exercise, we derived a list of 11 best stocks meeting all of these characteristics that one can hold now and forever. New investors often make a mistake in believing that the stock market is an exciting place where millions of rupees can be made in a short span of time. In reality, investing in stocks over the long term is incredibly boring and often involves hard work. It is not as exciting as many think it is. If someone is looking for excitement, one can speculate in the derivatives market, buy a lottery, or even place a bet in a casino. If you were to ask a newbie investor what kind of annual returns he expects from the stock market, more often than not, he would probably say 30%, 50%, or even more. After all, if he is going to take a risk with his capital and choose to invest in equity instead of a fixed deposit, then the return must be high enough to take that risk. This is because investors, especially inexperienced ones, are loss averse, not risk averse, which makes them choose exciting stocks. But seasoned investors are happy earning a reasonable return as long as their capital is safe and their wealth grows consistently over time. According to conventional wisdom, an annual return of investment, an ROI, of approximately 10 to 12% or greater is considered a very good ROI for an investment in good quality stocks. Now, one might say that 12% is boring, but if you think about it, over a time horizon of say 25 to 30 years, this could generate significant wealth for an investor. For instance, an investment of 20 lakh rupees at a CAGR of 12% would grow to 6 crore rupees over 30 years. Now, while 12% may seem boring, an amount of 6 crores is anything but boring. Hence, instead of trying to find the next big thing or spot market trends, an investor could be better off simply by investing a significant portion of their corpus in the best of the best stocks and watch them grow. If you still crave returns of 20%, 50%, 200% and more, look elsewhere. This is not the place to be. While one cannot compare stocks to fixed deposits as they do not promise a fixed return over the years, these stocks have consistently been able to provide safe and reasonable returns to investors. And the returns, along with dividends received from such stocks, have a track record of persistently beating fixed deposit rates. But what are the characteristics of these forever stocks? And what are the parameters on the basis of which one can evaluate them? Well, sit back and relax. We've done the groundwork for you. Here are the 11 best stocks of India based on a series of defined characteristics and why. Please note, the list of stocks derived is based on the use of certain parameters used by me for this specific exercise. These should not be considered as recommendations for any stock. Viewers may define their own parameters and characteristics to arrive at their own conclusion. Billionaire investor Warren Buffett has said that when owning stocks in well-managed businesses, his favorite holding period is forever. Forever is an exceptionally long time, even for a long-term investor like Buffett, but his statement makes absolute sense. No wonder he is viewed as one of the most successful investors in history. Now, if you can identify a business that never goes out of fashion, then you buy it and hold on to it forever. When it comes to certain businesses, they may change in specific form, but the business or service as a whole rarely goes out of fashion. Demand patterns for such stocks do not have an element of cyclicality. Such stocks may be viewed as boring, but tend to be less volatile and also manage to protect price and returns during tough times due to their stable nature. Their USP, staying relevant. These companies are always slightly ahead of their time and well ahead of their competition. Hindustan Unilever or HUL is a classic example. For instance, with over 85 years of heritage in India, HUL is India's largest fast-moving consumer goods company. On any given day, 9 out of 10 Indian households use its products. Imagine HUL going out of business anytime soon. Highly unlikely, right? Hence, the first characteristic of our best stocks list is being in a business that never goes out of business. These stocks may not be the hottest names out there, but have a high chance of delivering steady growth over many decades and beyond. The stocks that make it onto our coveted list have impressive growth credentials. In terms of historic growth, our companies have been impressive on the top line as well as on the bottom line, thanks to rising profitability. Businesses that can grow consistently for long periods tend to be rewarded by the market, delivering handsome returns to shareholders in the process. Our list of stocks comprises of leaders in their respective industries having reached massive size and scale. Hence, while some might call them mature firms or even seniors, these companies tend to produce higher growth than most mature companies given their industries and loyal client base. While these companies may not experience significant growth, nevertheless, they continue to grow and expand their operations year after year. Now, inexperienced investors often get blindsided by being fixed on only revenue growth. However, sales growth can be potentially misleading about the strength of a business because growing sales or revenue for money-losing businesses can be harmful if a company is unable to reach profitability. For instance, sales grew at a CAGR of 4.5% over the last decade for Adani Enterprises, from 46,400 crores in 2013 to 69,400 crores in the financial year ended March 2022. But if you consider profits for the same period, there was a decline of 52% from 1,600 crores to 770 crore. The median 10-year CAGR of sales is 11.9% for BSE 30 stocks. Our chosen 11 are close to this median figure with an average CAGR for sales coming in at 11.2%. For the same period, the mean 10-year CAGR of net profit is 11.8% for BSE 30 stocks. Our handpicked 11 perform better with an average CAGR for net profit at 12.3%. It is important to note that even though these companies might report weak numbers for a few quarters, they always seem to find a way to transform themselves and be back on the saddle again. Take the case of Mahindra & Mahindra, one of our picks. Between 2019 to 2021, the company reported a sharp decline in revenue. However, the company quickly realigned itself by consolidating its businesses and cutting out all its loss-making ventures. Simply put, the group's missteps which shrank its turnover, thereby dragging down group profits over the last few years, has almost been totally rectified. With this, the return on equity increased from 4.4% in FY 2021 to over 18% and revenue jumped 21% in FY 2022. While growth is a valuable metric for investors when analyzing a company, it doesn't matter much if a company's operations are not of superior quality. If the return on capital spent to achieve growth is less than the cost of capital used, then EPS growth reduces rather than increases shareholder value. Well, no such worries for most of our stocks selected, though, as their measures of business quality pass the test. The average return on capital employed, or the ROCE, for our stocks stands at 35.6% and the return on equity comes in at 28.9%. Operating profit margins are also noteworthy at an average of 29% for the last financial year. Finally, all of these companies have reported healthy operating cash flows, or OCF. OCF is the lifeblood of a company and arguably the most important barometer that investors have for judging corporate well-being. Now, if you're wondering why HDFC Bank and Bajaj Finance have a negative OCF, here's why. Banks primarily profit through lending, that's money going out, and outflow, but borrowers do not repay the full sum, that's the inflow, at one go. Rather, they typically pay smaller portions or installments over time. Hence, outflow will tend to always be more than inflow, which makes it negative. Consequently, it's logical that well-performing banks and NBFCs have negative operating cash flows due to increased lending, which indicates that people are borrowing from these banks, and in turn, the bank will profit. Again, some of you might be perplexed as to how the debt-to-equity ratio is so much higher for both HDFC Bank and Bajaj Finance as compared to the other companies on our list. Well, that's simply because banks and NBFCs tend to have higher debt-equity ratios because they borrow capital in order to lend to customers. While you might be happy that you own shares in a great company, it wouldn't matter much if no one else agrees with your reasoning and the share price is left to languish. For stocks to qualify on our list, we decided to check how the market perceives them. As most of our 11 elite stocks are household names, share price momentum suggests that they have plenty of fans as well. The average CAGR for our list of 11 stocks over the last 20 years is an impressive 22%. The best performing stock over the last 2 decades is Bajaj Finance, having reported a CAGR of 43%, while even the lowest performing stock, Hindustan Unilever, has an impressive CAGR of 12.6%. Business today is characterized by relentless change, which is why companies on our list continually evolve to stay relevant, innovative, and competitive. The difference between great companies and the greatest companies is that great companies are really good at doing particular things, while the greatest companies are really good at learning how to do new things. A characteristic that stands out for our cherry-picked companies is that they are quick to read and act on signals of change. These companies have worked out how to experiment rapidly, frequently, and economically, not only with products and services, but also with business models, processes, and strategies. They have built up skills in managing complex multi-stakeholder systems in an increasingly interconnected world. Perhaps most important, they have learned to unlock their greatest resources, the people who work for them. Growth can be defined as an increase in the scope of activities or renewal of capabilities. Usually, a good reason for growth is to become more competitive. For our chosen 11 companies, every time the core business has been under threat or these firms have reached the limits of their natural market, they have gone on to stretch and grow. Or perhaps the company's existing resources weren't being used effectively, which led to alliance-based activity that brought access to new technology and new people. Our companies have never succumbed to pressure from their investors to just grow for growth's sake, as this would lead them to seek results at any cost, resulting in aggressive and often expensive acquisitions. We do know that 70% of acquisitions fail. Take the case of Nestle India. While looking at the company's growth over the last 10 years, one might feel that it has been unremarkable at a CAGR of just 6.5%. But if we were to break this up into two periods, the picture looks a whole lot better. Between 2013 and 2017, Nestle's sales grew at a CAGR of just 3.7%, but between 2017 and 2021, the growth has improved to 10.1%. So what did the company do to achieve this? You guessed it right. Adapt and evolve to stay relevant once more. Since 2016, Nestle adopted a growth-led strategy that involves frequent launches to expand its portfolio and going deeper into untapped markets. Traditionally an urban-centric company, Nestle began pushing the throttle on rural expansion in late 2017. The scale-up has been impressive. From 1,000 villages in 2017, Nestle now places its products directly in almost 100,000 villages, and it aims to expand to 200,000 rural habitats within the next few years. Nestle has accelerated an investment plan of 5,000 crore rupees till 2025 to grow its India business faster. By the looks of it, the pace of growth appears unlikely to slow down in the future. Have you ever eaten a heavy meal and feel that you'll explode if you were to eat any more? And just then, someone brings out a cake and you find yourself reaching out to grab a slice. Well, it's not just you, that's human nature. Everyone wants more of the good thing. While our 11 companies have a track record of providing reasonable returns for investors, there is something else they do to keep investors excited. Over the years, all of these companies have rewarded investors with a whole bunch of extra goodies. Be it bonus issues, stock splits, buybacks, or hefty dividends, these companies have gone the extra mile to keep their shareholders happy. L&T has rewarded investors with a mind-boggling 10 bonuses over the last 7 decades. ITC and Mahindra aren't far behind with 7 and 6 bonus issues respectively. 8 of our 11 companies have split their stocks as well. And if we look at the dividend history for the last decade, all the stocks have paid healthy dividends to their shareholders. The average dividend as a percentage of face value for our stocks is at over 1,150%, with the highest numbers coming in from TCS and the lowest from Reliance Industries over the last 10 years. So there you have it. From the perspective of a series of characteristics, these are the 11 best stocks that one must aspire to own. Even high-risk investors must consider owning these stocks to diversify their investments. Since these stocks are relatively stable and provide regular dividends, they can help one meet their long-term financial goals with ease. As an investor, you can make a fair estimation of how the prices of these stocks will move in the long term hence allowing you to plan your financial goals. And with that, we come to the end of this video. I hope that you found this helpful. Thank you so much for watching. Happy investing. Goodbye.